Ever wondered why a stock that's been solid for years suddenly takes a hit? At Insightful Value, we dig deep into these market puzzles, and today we're spotlighting Erie Indemnity. The stock has slipped recently, and while the headlines might have you spooked, this could be a case where the story under the surface looks very different. This breakdown is for educational and informational purposes only, and not financial advice. Erie Indemnity might not be a household name like some big insurers, but within the insurance world, it's a respected and quietly consistent operator. The company acts as the attorney-in-fact for the Erie Insurance Exchange, managing operations and earning a percentage-based fee from premiums written by the exchange. In simple terms, it's a management company that runs the business side of one of the nation's top regional insurers. This unique business model gives it a steady revenue stream, low capital risk, and operational stability. And it's been a slow and steady winner for long-term investors. So why is the stock down? Well, the company has seen slower revenue growth compared to previous years, and margins have tightened. Operating expenses have been ticking up, partially due to inflationary pressures and ongoing tech investments. The latest earnings report showed a modest decline in operating income, and investors responded with caution. But let's zoom out. Erie's fundamentals remain strong. The company continues to generate consistent free cash flow, maintains zero long-term debt, and has a history of stable rising dividends. It's the kind of stock that doesn't make a lot of noise, until it does. From a value perspective, this drop could be a temporary market overreaction. The company's fee-based model ensures predictable cash flows that aren't directly tied to underwriting risk. That makes it attractive in uncertain times. Add to that a clean balance sheet, low volatility, and a track record of shareholder-friendly policies, and you've got a stock that checks a lot of boxes for conservative long-term investors. The valuation has come down slightly, and while it may not scream deep value, it definitely looks more attractive now than it did 6 months ago. There are some catalysts to keep an eye on. Erie is investing heavily in tech upgrades and digital transformation. Not exactly exciting headlines, but critical moves in today's insurance landscape. The company has also continued expanding into underserved regional markets, growing its agency network, and maintaining strong policyholder retention rates. These aren't flashy growth strategies, but they are effective for a company that plays the long game. At Insightful Value, we spotlight companies like Erie Indemnity, quiet performers that can fly under the radar until the market catches on. We take the time to break down the numbers, simplify the story, and show why some companies are worth a second look, even when their stock is stumbling. Want more insight like this? Visit us at insightfulvalue.com. Whether you're a seasoned investor or just starting out, we make value investing approachable, actionable, and jargon-free. If you're into long-term thinking and real analysis, you're in the right place. Be sure to subscribe to our channel for more value stock breakdowns and visit insightfulvalue.com for full reports and updates on Erie Indemnity and many more.